Hi, everyone. Thanks, Shauna. My name's Chris Reichert. I'm from 1991, so this is my honor for me as well. I'm here to welcome you on behalf of the Alumni Board. The Rice Business Alumni Association Board is a working board, and each year we select projects and split into working teams to try to move things forward. Our basic goals are to help alumni stay connected, get involved, give back, and continue to learn through programs just like this one. We've also launched a podcast, which you can get to on the website. It's called Owl Have You Know, which is a pretty cool podcast. So thank you all for joining us for the faculty session today with Dr. Brian Akins. We really appreciate you taking all this time to participate in our first ever virtual alumni reunion week. We're only able to host programming that you'll enjoy today because of the generosity of our alumni. For those who don't know, the Jones School doesn't actually receive any funding from larger Rice University. That's actually was new information to me a couple years ago. We wouldn't be where we are today without all of your support, our alumni support, and truly appreciate you all giving back your time, talent, and treasure. And we ask that if you can, please consider making a gift to the school in honor of reunion. This week, our goal is to secure an additional 360 donors to reach 20% more alumni participation to the Rice Business Fund. There'll be a link later in the chat if you want to click on it. Again, thank you very much for joining us today. I'd now like to introduce our wonderful guest speaker, Dr. Brian Akins. Dr. Akins is an associate professor at the Jones School and teaches financial accounting in the full-time and professional MBA programs and the PhD program. Dr. Akins is a fellow alumni, full-time MBA class of 2006. So this is his reunion year as well. Please help me welcome Dr. Akins. Brian?
Great, thanks, Chris. I appreciate very much being able to be with y'all today. I was kind of reading through the names as y'all popped up, and I think I know about half of you. It's hard to say for sure because once I don't have you in class anymore, I forget which program you're in and what your last name is. But I think I know about half the people on the screen. I could be wrong. So really appreciate y'all showing up, especially those of you who know me because you already know what you're getting into and you have a rational expectation of this and you came anyways. So cool. Thank you. Appreciate that. I'm going to share my screen here, which is going to throw things onto various monitors and then I'll have to shift it back, but that's okay. I can do that. So like Chris said, I am a Jones alum like y'all. I graduated class of 2006 in the full-time program. So this is my reunion weekend as well. And excited to be able to share some with you. So been since 2006 when I graduated, went initially to Cornell, did a year in the PhD program in finance at Cornell, and realized that a lot of the things that I was interested in terms of research were actually being done by accountants, which blew me away because I did not really see how it connected to accounting at all. But turns out that a lot of accounting research is really about information economics. So it's about things in finance, but it's about how that information gets communicated in the capital markets or how the information gets processed. And so I'm not really sure how as accountants we got into that because that really is econ, but that's pretty much what we do. So after a year at Cornell, decided I'm really interested in this stuff. This is really cool. And so I sent out some emails to a bunch of different top PhD programs in accounting without having actually applied and passed their deadlines and said, hey, I'm kind of interested in this. And would you have any slots? And got back some pretty harsh emails from, Stanford and some of these other places. And then MIT emailed me back and the head of the PhD program said, we had no applicants this year who were above our minimum bar. So if you want to come interview, we'll consider you. And that ended up working out and spent 5 terrible years at MIT, got my PhD and got to come back to Rice as a professor. And I've been here since 2012, teaching PhD classes and the core in financial accounting. So I appreciate y'all coming with me to hear a little bit about my research. Before I get into my research, just so you feel a little more comfortable with me, this is my family. This is my wife and my daughters. Adelie is my oldest, and she is almost 20, and Eliana is 17. Eliana is a sophomore in high school. Adelie is generally at Trinity in San Antonio, but she's out this year because of some health issues. So hopefully that all gets resolved and she's able to go back. But this is our family. And then this is the other member of our family. This is Mia, whom, because I am doing this Zoom from home, if somebody gets too close to my house, you will hear throughout the call. But the girls wanted to dress her up as Princess Leia for Halloween. I was very much opposed to this because she's a Doberman, and I feel like Dobermans are supposed to have a certain look. But they were like, no, come on, she'll be really cute. And yeah, it's really cute. So that's our family. So I'm going to talk a little bit about some things that I've been looking at in research and just kind of like share with you what I do and hope that you get something out of that. So it's my expectation that because this is Saturday afternoon and you've probably already been to Annie's lecture and other things throughout the day, that you probably don't want to dive too deeply into the weeds of academia and a bunch of econometrics jargon and things that you're not going to be interested in or actually find that useful and that are going to get boring. So my hope is to just give you some things that you feel like you learn something without boring you and getting too detailed. That's my goal. So in terms of questions, I'm totally cool as we go through this. If you just want to jump in and interrupt me. Again, I teach in the full-time MBA program. So I am used to being in front of 60 people and having them just interrupt me and ask questions. It's like, it feels weird if nobody says anything to me. It makes me feel like people are checking their email instead, but and I'm not being very interesting. So feel free to jump in at any point and ask me questions, clarifications. And if you are someone who wants to get more deep in the weeds, I'll stick around afterwards and feel free to talk about that as well. So hopefully you're all still here. I can't see your faces, but hopefully that helped. Okay, kind of as I start out, what I wanted to do is just kind of ask, and this is actually going to require at least somebody unmuting and answering. How do you think academics come up with research ideas? Like if you had to guess, because I mean, at this point, you have MBAs, you're involved in business, you have some expertise in different areas. And so honestly, you probably know more than a first-year PhD student who is trying to come up with ideas. So if you had to come up with some kind of research idea about business, how would you come up with an idea? Where would you start?
I'm guessing it's a combination of interest and trends of what's happening out there in the market.
Okay. Yeah, definitely interest is a big deal. And what's going on around trends in the market, things that you see. Anyone else have any ideas?
I think a desire to help solve problems.
Yeah, that's a good answer. A desire to help solve problems is great too, right? You don't turn out to be a very good academic if you don't like problem solving. It just doesn't work.
I would think if you encounter something and either through your network or your own self, and you just have a curious question, like, well, why is this the case, or whatever, and you form a hypothesis, and then you want to pursue thoroughly answering that.
Great answer. Yep. And I say that's a great answer because that's often what happens with me. I see something and I'm like, really? What is that doing there? Right? I don't understand why that's there and I want to figure it out. So yeah, these are all good answers, right? So academics come up with ideas from research from various areas, right? I mean, first of all, you got to find something you're interested in. So for me, I primarily do debt research, debt markets, debt market intermediaries, things like that, right? So credit rating agencies, banks, syndicated loan structure, bond trading issues. This is what I'm much more interested in overall, right? Now, someone like Alan, who I assume some of you will go watch after this, Alan does a lot of mutual fund work, right? And so this is actually very important, right? A lot of us have investment funds and retirement funds. So it's very important that somebody is studying mutual funds and trying to figure out how they work and best practices. That being said, I have zero interest in being that person. Don't get me wrong. I'm glad Alan's doing it because I do have a retirement fund and somebody needs to look at that stuff and make sure it's being run right. but it's not really my thing, right? I like debt stuff. So it's got to be some combination of personal interest. And then what I think it was Chris that said is, sometimes current issues, right? And so, somebody in accounting may say, okay, how are companies treating COVID and COVID related performance in their financial statements? How are they communicating that? And then how is the market processing that information? That might be something that somebody looks like, current issues, right? Something that Matthew said that is very much me is sometimes I'm reading through something and I see something and I think that's just weird. Is that a one-off, or do other companies do it? And then I start digging around and find out other companies do it. And I'm like, why? So for me, that motivates a lot of my curiosity and a lot of my research agenda. Sometimes it's by looking at other academic papers and just saying, okay, this is kind of what other people are doing. I read that study and something doesn't feel right about it to me, so I'm going to go look at it further. Or I read that study and thought it was really cool, but maybe they should have pushed further. I have other ideas related to that I think are even cooler. And so you try to come up with stuff like that now. That's a lot of how we come up with ideas. Now, that being said, within different fields of academics and different specialties like mutual funds or debt markets or equity markets and things like that, different things drive the overall body of research, right? So one thing that's really interesting to me personally, again, because it's debt, is that debt market research has spiked incredibly in the last 20 years. So 80s, 90s, tons of research on the equity markets, tons of research on how things affect equity investors, how equity investors affect other things, but a lot less about debt. And part of that is, a huge part of it actually is just due to data availability. Stock market data has been readily available to academics and everybody else for a really long time. But honestly, up until the very end of the 1990s, there weren't great sources for large scale information about debt. There just weren't. Bond or loan contracts. It was very hard to get, and it involved a lot of hand collection. Since then, there's been a lot of progress made. There have been a few data sets developed. And in addition to that, computing technology has increased to the extent where we're able to better search and scrape contracts and pull information from it. And so there's been a lot of progress made in debt market research over the last 20 years. And I actually think this is a really big deal. One thing that I found very interesting when I was in grad school and I was looking at it, I initially started off thinking I'm going to do asset pricing stuff because everybody loves asset pricing stuff. That's cool. That's flashy. It's, and plus I had a little bit more of a background with that. And so I was kind of rolling into it thinking this is what I'm going to research. And then I started reading more and doing more and looking at actual debt versus equity markets. And the equity market in the United States is much larger than the debt market, the outstanding equity. So it's about 2 years old, but there's roughly $30 trillion in equity from US companies. Whereas debt is about $2 trillion for US companies. Now, that's total outstanding in those markets. Something that I found very interesting when I started looking into this is that when you look at new issuances, right? Because a lot of that equity's been out for, decades. So you look at new issuances. When a company wants to go to the market, I'm sorry, I'm going to move around a lot. Those of you who've had me in class know I don't stand still well. It's definitely not one of my core competencies. So I'm doing my best. I even made myself sit down so I wouldn't walk, but I'm going to do my best, but I'm going to move a lot. So I apologize if that makes you seasick. Now, when you look at new issuances, one of the things that's really cool is that it's actually very different in terms of the magnitude of new issuances. In 2019, there were $2.1 trillion of external capital raised by US companies in the markets. 1.8 trillion of that was debt. Literally, about 86% of new capital raised by US companies is debt. Now, that debt takes various forms. There's the bond market and there's the syndicated loan market. The syndicated loan market, some of you probably already know what syndicated loans are, and I apologize. I'm not trying to be condescending. By explaining this, I just realized that people come from different backgrounds, and so I want to make sure that we're all on the same page and able to follow this. A syndicated loan is not that complicated. It's not that, there's nothing, kind of particularly opaque about this. What it is a group of banks forming a syndicate to issue a loan to a company. That way they split the risk among the banks. And so it's a way of diversifying among the banks. It's not always banks. Hedge funds get involved too, but it's financial institutions. So it's a way of kind of diversifying the risk in the private loan market. And so syndicated loans have grown exponentially since the early 2000s. And so of that $1.8 trillion in 2019 that was raised in debt in the US markets, almost 60% of it was through syndicated loans, much more so than public bonds, right? And so syndicated loans have become more and more important to the functioning of American corporations in the US economy. And so one thing that has interested me in terms of research is syndicated loans and how syndicated loans work, and kind of the effects that can have on companies and corporate outcomes as well. So the governance of the companies themselves and the corporate outcomes. So what I wanted to talk about with y'all today is just a series of projects that I've been working on. And now Mayank put his picture up, and I'm sure I know him. So I figured probably, but yeah, definitely. One of the things that I got interested in a few years ago, and this was exactly what Matthew was talking about, and I'll explain, this is going to be the second paper I talk about here, is how creditors affect corporate governance. Now, when we think about corporate governance, what are we talking about when we talk about corporate governance?
The board of directors, the managing kind of the overall kind of direction of the company.
Yeah. I appreciate that. Is it Tanay?
Yeah, that's right.
Awesome. Appreciate you jumping in, Tanay. Yeah. So when you think about corporate governance, it's a term that gets used a lot, but it broadly refers to the mechanisms and the processes by which the corporation is controlled and directed, right? And so we typically think about the board of governors, board of directors, which is totally right, because they are fundamentally the ones responsible for the corporate governance of the company. Now, that being said, there are a lot of other stakeholders who influence corporate governance, right? You've got auditors, coming again from an accounting perspective, right? Auditors are supposed to be there saying, look, the financial information you communicated is valid and sound, and they provide a certification that gives external users of those financial statements some sort of comfortability in knowing that this is actually useful information and it's accurate relatively, right? And so auditors impact that. Obviously, the managers and the staff are going to impact corporate governance because they're affecting how it filtrates down through the company, right? And then there's other stakeholders and shareholders. Now, historically, in the academic research, when we've looked at corporate governance, overwhelmingly, what we have thought about are these two right here. We've thought about the board committees, and shareholders. Now, in accounting research, we've also talked a lot about external auditors. So that showed up a lot too. But a lot of research has centered around the board, whether we want staggered boards, whether we want independent boards, what kind of experience we want the boards to have, et cetera, et cetera, et cetera. Is it bad for the CEO, chief manager, to be on the board? Is that too much power? Things like that, right? And then also how shareholders actually affect corporate governance, because they're the ones who obviously are responsible for electing and choosing the boards. Now, part of that is also because data availability, to be honest. Part of it is also because data availability, because we had available data on these issues, right? But when you start thinking about corporate governance and every kind of stakeholder that actually impacts corporate governance, it's actually way more complicated than that, right? So I put managers in the middle on this slide because really the day-to-day operations of the company aren't the board, right? The board oversees the management, but the managers are the ones who are enacting the day-to-day operational decisions. And so when you start looking at that, you're like, okay, so who influences what the managers do and how they do it? And obviously the board and the auditors are still there. Investors, these are kind of what we talked about on the last slide, these three. But Customers, you can have very strong customers. You think about a company that has, 5 or 6 major customers, and, the customers can have a lot of influence. The suppliers, labor unions, less so in Texas than some places, but still, labor unions can be a very big deal if they exist in that particular company. And then you have different media, regulators, especially depending on the industry, can be huge, analysts and creditors. So for me, being interested in the debt markets, one thing that I've been really interested in the last several years and looking at in my research is, how do creditors impact corporate governance? How do creditors influence corporate governance, or do they, right? And this is something that's been largely neglected. The one exception to this being neglected in the literature, I'd say prior to the past 6 or 7 years, is that when companies are in default. That's been the one time where this has received some real legitimate, deep, and broad research, right? Because when companies are in default, everything gets thrown over to the creditors and to the courts. And so people are really interested in understanding how that works and what that looks like. And so a couple of my co-authors, one in particular that, again, looking at the name some of y'all had, was David DeAngelis, who probably taught your econ class, depending on what program you were in and how long ago you graduated, your micro class. So so David and I started talking about some of this, right? Because David does a lot of corporate governance stuff, and I do debt stuff. And we were actually having coffee, going back and forth at the Jones School across the street to get coffee, and then going over to the gym. And we started talking about this, and it just seemed like there was something missing in the literature. Like creditors, there's no way, me, ex ante, again, I'm super biased because I do debt research, right? But for me, ex ante, I was like, there's no way that creditors only matter when the company's in default. I mean, some of these loans are huge. There's no way that the manager of the company is just thinking about everybody else until he starts getting close or she gets close to default. It's got to influence what they do, right? And we spend all this time in business school talking about corporate investment decisions, but also corporate financing decisions, right? A lot of y'all took Alan's class, and I don't know if he's still teaching that. I think he might still be, but the corporate financial policies, right? And so they spend all this time thinking about these financial policies and what they're going to issue and how and the structure of it. And there's just no way that this doesn't influence things. And so we started getting interested in looking at how creditors affect different aspects of corporate governance. And so we've got a series of papers really just looking at that. And so we've got, I'm going to go over 3 papers here. Again, jump in whenever you want. Feel free to knock yourselves out. It's not going to offend me. Again, I'm used to like 60 some people asking me questions, and I like teaching MBAs. So I'm totally good with it, right? So we're going to look at how creditors impact 3 aspects of corporate governance: ownership, management, and managerial compensation. So I'm going to start off talking about ownership. This is actually the newest of these 3 papers. And I'm just going to give you like a high level overview of what we're doing, and let you ask me questions as we go through or not. All right. So ownership, how creditors affect corporate ownership. This I thought was really interesting. And I was very much surprised by this. So let me set you up and see if you would think similarly to what I did. You might be smarter than I am. So we'll see how this goes. So if you're thinking about a loan contract, right? Again, a lot of what I do is looking at syndicated loans. And so syndicated loans are huge, very important in the market. These loan contracts, have any of y'all ever seen a syndicated loan contract? I'm going to take that as a no.
Never seen one.
Okay, I appreciate you answering today. You're awesome. So very much your participation, if this were being graded, would be excellent. So thank you, sir. Yeah, so a syndicated loan contract, I have one that I use in my PhD class. It's about this thick. It's about 600 pages, super detailed. The loan, I mean, we're talking a $500 million loan for this particular loan contract, right? So there is an incredible amount of detail, right? It talks about the basic terms of the loan, obviously the maturity, the interest rates, if there's any kind of performance pricing collateral requirements, different things like this, right? In addition to that, it has all these terms set up that are financial covenants, right? Now, a firm can default on a loan two possible ways, right? There's what's called payment default, where they miss an interest payment or a principal payment, right? And then there's what's called technical default. Technical default is just the violation of one of these covenants within the loan. Now, these covenants are expansive. I mean, there is just pages and pages and pages of covenants, right? And they are things that you might actually anticipate if you started thinking about it, right? They are things like the company must maintain ROA above X threshold. Why? I mean, the creditors are concerned about getting their money back. So if the company starts tanking and ROA falls below the threshold, it's a technical violation. The loan gets thrown into renegotiation, and the creditors get to say, well, they get to do what they want. Maybe it's just a little bit below and the creditors are like, don't worry about it, not a big deal. Or if it's a lot below, the creditors can demand acceleration repayment of the principal on the loan. So it's kind of a big deal. It gives the creditors a lot of power as soon as we violate one of these covenants. So there's covenants about performance. There's covenants about leverage, right? Like, okay, you borrowed money from us and now let's say your leverage is like 30%. We don't want you hitting 60%. We're concerned about that. So there will be some kind of threshold about how levered they can get. There's covenants about lawsuits, right? If you lose lawsuits over X number of dollars, then you violate this and you're in technical default and we get to renegotiate. Things like that, right? Does that kind of make sense?
Yes.
I'm going to assume, thanks, Nat.
Yeah.
I'm going to assume other people nodded. And Felipe, appreciate that. All right. So in terms of ownership, what do you think creditors might be concerned about in terms of borrower ownership?
Just the ability to repay.
Yeah.
Okay. And why might ownership
What
affect
about the
that?
borrower's background, in terms of being able to perform on the business and everything like that? So.
Okay, good, right? So one of the concerns, I appreciate that, Tanae and Nat both. One of the concerns is, well, wait a minute. We're making a loan with this company that has a certain profile, right? But if the company gets bought out by somebody else, they can totally change what this company looks like. So the profile of the company looks different. Crud. We made a loan to a company that looked like this with these terms, and now the company looks like that, and we can't do anything about it. So one of the things that you might expect is that creditors would want to limit ownership changes of the firm. And again, ownership, I mean, we're talking, very much basic corporate governance here, right? The owners vote for the board. And so my expectation, this is actually what happened. We were working on the next paper I'm going to talk about. It's the oldest of these three papers. And that particular paper looks at creditor restrictions on who the managers are, which is a really cool idea. I'll explain it in a little bit, but this is the newest one. So I kind of started with this one. We were working on a revision for that paper. And someone said, you know what? One of the pushbacks we were getting from one of our reviewers at this journal was all this is it's just trying to limit changes in ownership. So we started looking at the change in ownership clauses. And I read tons of debt contracts. And I never really looked that closely at the change in ownership clause. So my expectation going into this was, yeah, there'll be a restriction on change of ownership. I mean, there's got to be, right? You don't want the company going from this to this. But I kind of expected what would you have guessed, like, as far as like the threshold or for what that change in ownership should not pass, right? When does somebody else really have control of the company?
50%, 20%.
Yeah.
50.
So technically 50% is when they totally get ownership. Now, someone else said 20%, which is good. You think better than I do, apparently, because I expected everything to be 50%. Because once you have 50%, you can say, okay, yeah, you sell shoes, Now we're going to make airplanes. I mean, it's not very rational, but you can technically do that. What we actually found looking at these clauses was that a lot of them were actually most of them were way less than 50%, right? And I think that goes back to, I don't know who said 20, but we teach this in core accounting, right? Once you hit that 20% mark, you have to account for the investment as an equity method investment because you have significant influence over what's going on. That's what we actually found. So here's an example from Lionsgate. And this was taken from Business Week in 2009 about Carl Icahn. So, is the movie studio Lionsgate Entertainment using a loan covenant to fend off Icahn? When JP Morgan Chase extended Lionsgate's revolving line of credit last year, the terms included a provision that triggers instant repayment if an investor buys more than 20% of the company's stock. Since then, Icahn has acquired 14% of Lionsgate. So here you have a activist investor coming in, trying to gain significant influence of the company, and he can't because the creditors are like, when we wrote this loan, we had a certain expectation of what the ownership looked like. And if Icahn comes in and gets 20% of the company, that totally changes, and that guy's going to throw his weight around, and we don't know. So this is actually what we found. So what we did in this paper is we kind of went through and looked at this and said, okay, when do we see these being used, and kind of what are the effects of it? And what we actually found, these change in control thresholds or these caps, the highest frequency of these, if you look at the histogram, were actually in the 30%, which was, again, really surprising to us. We were initially thinking 50%, right? Because that's when you can do whatever you want. But it turns out a lot of these creditors did not want anybody gaining more than, 30-something percent, 20-something percent. We even found some that less than 20 is a pretty small group, but we found some that literally had 8%. Like they were that concerned about dealing with a powerful investor in renegotiation, or even outside of renegotiation, a potential investor changing the direction of the company. So what we did, we kind of went through and looked at when these clauses were used and some of the outcomes of it. And basically what we found, this is just an example here. This is made up numbers, but let's say that firm A and firm B. If I go too fast, this doesn't hit, ask me to repeat it. Or if I go too fast and this doesn't hit and you don't care, you're not any worse off in life. So it's okay. One of the things we were thinking about when we did this was we were like, look, let's say these are equity block holders, the bars, right? Represent how much equity these two companies, these block holders have in these two different borrowers, right? So with firm A, when they get the loan, it's pretty obvious who the dominant block holder is going to be over the course of the loan, right? There's not a lot of uncertainty about it. Now, it is possible that this could change, but first bar is pretty much dominating ownership. But look at firm B. Which of those equity block holders is going to be the most powerful in a year? Well, it might still be the first bar, but it's not going to take a lot for this one to pass the first one, or this one. Or what if this one buys that one? There's a lot more uncertainty about this ownership distribution than there is about this ownership distribution. So we went in, we investigated this, looked at it statistically, and actually we found situations like this were much more likely to employ these restrictions and to have the restrictions set at a lower level. Instead of 30%, 20%. So that's kind of like something we went through and looked. The other thing we found is that these minority block restrictions, we call them minority block restrictions because they're less than 50%, right? They're restricting you from buying more than a set minority of the company, minority percentage. And so we found that they're actually being used more over time. The percentage of syndicated loans in our sample in 2015 that was actually using these was, up close to 65%. Whereas back in the mid 90s, it was more like 40. So huge increase in it. And then another thing that we found is that we actually found that ownership concentration is decreasing. So what does that mean? That means that since the early 90s, the mid 90s, companies look less like this in terms of ownership and more like this. And this led to, now I know that just showing the two graphs doesn't prove causality, but we ran a bunch of other statistical tests, the results of which, with which I'm not going to bore you because, you know, it's Saturday. You should enjoy your day. But we did test this statistically, and it is robust. It's really nice. And so it looks like what's happening is that creditors are concerned about who is controlling the company, the owners. And so they have these restrictions built into a lot of these syndicated loan contracts now where they are restricting ownership so that they know who they're dealing with. And that is definitely a direct influence of creditors on corporate governance, right? Actually, that may be the most fundamental influence of creditors on corporate governance. I mean, you just don't get much more fundamental to governance than the ownership of the company, right? Because they choose the board. It's not always easy, but yeah. So second thing I'm going to talk about, this is management. This is something I was surprised to see in large companies. And this is actually kind of what got me going down this track in the first place. So Matthew had said one thing that, one way that academics come up with research ideas is just seeing something that looks weird, right? So as a PhD student, I went to my advisor and I said, I'm going to do debt research. And my advisor is huge, he's a full chair professor at MIT, which in accounting research is one of the top 2 places on earth, basically MIT and Chicago. So he's a big deal in debt research. And so he looked at me skeptically and he was like, I don't know. He's like, I thought you were going to do asset pricing. That's way more flashy. I was like, I'm not really a flashy kind of person. That's not really, I think debt's important. It's interesting. And so he's like, okay, you want to do debt research, read this book. And he gave me a book that was literally this thick. And it was a book for first-year law associates on how to draft debt contracts. And some of you may be lawyers and may be trained in reading such books, but for me, it was brutal. So it was brutal. But I was a good 700 pages into the book. And I read, it was talking about potential covenants you can put in these syndicated loans. And it said, hey, you can restrict the company to only having a certain manager. Like you can literally say, I want you to keep that manager over the course of the loan. And if they don't, you violate the covenant and the loan gets thrown into technical default. However, don't do this. Again, this is a legal book written for lawyers. It said, don't put these in loan contracts, because if you put this in a loan contract, and then the company performs badly under that manager, what's going to happen?
They're going to
can't get rid of them.
You can't get, well, the bank can get rid of them, but who can't?
Management.
Shareholders can't.
Or shareholders.
So how do you think the shareholders feel about the bank saying you need to keep manager X, and then under manager X, the company just falls apart?
Yeah, shareholders won't be too happy with that. And they
right. And then
could they then plan like some type of hostile takeover or anything like that? And does that affect the covenants on the loan?
Okay, good question. It doesn't even have to be that like a hostile takeover. They already control it, right? But what they do is they sue the bank. So that's what it says. It says, hey, by the way, don't put these in there, because if you pick a manager and you say, keep this manager, and then that manager runs the company into the ground, you're getting sued. And guess what? Here's some examples of that having happened in the past. So don't do this. And I read it and I thought to myself, okay, why do you have to tell people not to do it unless somebody's trying to do it? Right? So this kind of goes back to the Matthew. Matthew was like, oh yeah, sometimes you just read something and you're like, wait, why is that there? That's exactly what happened. I was like, wait a minute. I have daughters. They're close to grown now, but when they were younger, I never had to tell my daughters like, hey, don't sneak into the refrigerator late at night and eat the leftover broccoli. I didn't have to say that because nobody's trying to do that, right? What I do have to say is, hey, that leftover cake, you're done for the day, put it off to tomorrow because they try to eat it. So I was like, look, somebody's trying to do this. I mean, why do you say this to lawyers unless somebody's trying to do it? So we started digging around and actually found out, yeah, there are companies that are trying to do this, right? So here's an example. This is an older one. This paper's already published. This is in the Journal of Finance now. But Cobra Electronics. So if you're not familiar with Cobra, they make like radars for like fishing boats, they'll go out and kind of radar to help you find the fish, and also radars for police cars. So for you to detect police cars, which I think is illegal in the state of Texas, I'm not sure, but I'm definitely not advocating the product. I'm just telling you what they make, and what you choose to do with the information is not my fault. So Cobra Electronics, this was a $50 million loan. In the loan contract, there is a situation, there's a section called events of default, where it basically just says, look, if you do any of the following things, you default on the loan. One of those things is here listed in A, B, C, D, N. James Bezet, change of management. If James Bezet shall cease to be the chief executive officer at the borrower at any time. Now, this is a big deal, because what happens if James Bezet quits?
Or dies, the loan's in default.
Yeah. It's even more intense than just quits. You just jumped ahead of me, but you're totally right. So so if James Bezet quits, loan is in default. If James Bezet gets fired, loan is in default. If James Bezet dies, the loan is in default. How intense is that? And before you're like, wait a minute, that's too extreme. Nobody thought of that. Found tons of these where it said basically the same thing, unless due to death or dismemberment, which I thought was a little bit gruesome. But yeah, they literally have considered that. But this one, if he dies, default. That's how important they thought James Bezet was to the functioning of this company. It's pretty amazing, actually. Now, you can think about, well, let me ask you, when do you think these loans would be used? Because again, this is super risky for a bank to put that in there, because if things don't go well, the bank's getting sued. But they're still putting them in there sometimes. So when are they going to really use this?
My guess is with personal relationships. I was in a business that had a similar type of deal where the commercial line of credit, it was an Omaha-based workers' compensation insurer that was relatively small. And our line of credit to finance our ongoing growth and operations was a syndicate of 5 different Omaha-based banks. Omaha State Bank was the lead bank. The guy who was in charge of Omaha State Bank had a very, very close and personal relationship with the guy I worked for, our CEO. And they had clauses like that in there. And part of the reason I think that that was the case was Omaha State Bank, and I'm sure that you would say it's a conflict of interest. I have no idea. I'm not a pro at this kind of stuff. But Omaha State Bank also made loans to the key executives of the company so that they could acquire more equity. And it wasn't a personal guarantee on those loans. Those loans were guaranteed by the equity in the company, right? So you're borrowing money. I did this too. You borrow a bunch of money from Omaha State Bank. You get a ton of equity, hoping that it doubles or triples. You're paying them an above market interest rate. And the guy who's running the whole thing, running the whole package, is also managing all the banks that are doing your operating line of credit. And the whole thing is based off of his personal relationship with my boss, who was our CEO. And it all turned out okay in the end. Eventually it all turned out okay. Nobody defaulted on anything, but there were times when the board of directors was like, kind of had it out for the CEO a little bit, because they felt like that he was doing some things that were inappropriate, it was true. He was doing some things that were inappropriate, not from a business standpoint, but from personal relationships with other employees kind of thing. And he's just like, well, you get rid of me, guess what? all these, we have no line of credit anymore. All these loans
Yeah.
immediately due and payable, and we dilute the company, et cetera, et cetera, et cetera. So I think a lot of times, it's maybe not on things of this scale, but on the scale that I'm talking about. And when we eventually sold the company, we sold it for like $250 million. So it wasn't like a joke, right?
Yeah.
But it, Omaha is kind of a province unto itself, and the relationships up there, your personal relationships up there matter a lot more than they do in some other bigger, more cosmopolitan cities. So
in the end, it's all Warren Buffett's fault.
now I'm guessing that must have been really good friends with whoever they were borrowing the money from.
Awesome. I appreciate that story, Chris. So we went into this, we were like, why the heck is this stuff here? So we had two hypotheses. One, entrenchment, which is exactly what Chris's story demonstrated, right? That executives are lobbying for this to get in there to protect them from getting fired. Or two, the bank actually wants it there. Large scale statistical evidence, we couldn't find entrenchment. To be honest with you, I totally wish we had, because that is flashy. That's awesome, right? I know it does happen, but mostly what we found was that the banks actually wanted these there. When these were included, I'll spare you the statistical details. We found that the companies actually paid a lower cost of debt. So why would the banks want, on average, stuff like Chris said totally happens, but on average, why would banks want these in there?
Just stability of management, I would imagine.
Literally, that manager is that important to the stability of the company and to the performance of the company. And so where would you expect to see these? What kind of companies?
Close to bankruptcy, restructured companies, maybe.
That's actually possible. We didn't see there necessarily. Companies that have been started by an entrepreneur who's been so successful they've been able to keep control of the company through the IPO process, which, really most entrepreneurs lose it at some point before that, right? When the VCs get involved and stuff, right? So this is a really good entrepreneur. This is a really, really good leader for the company. We found it in companies like that. We found it in, kind of tech type things. And then this is just showing that we actually found it enforced. We found it
with the manager having some, specific skill set for the operational of the business. So
yes, we found it was human capital. When the manager has very specific and valuable human capital, that's when we saw this was really enforced, right? And really put in there. Like, you might think small companies. So 15% of our sample had a market cap of over $1 billion. And one of those was Lionsgate again. Now, most of the time it was on the CEO. Lionsgate, it's the movie company that makes a bunch of horror movies and the Twilight stuff. So, I got through that without making a joke about Twilight. So I'm pretty happy about that. What's that, Matthew?
Does this mean that banks in this situation have a lot of influence over who is in upper management? So they have this term in there that basically says so-and-so shouldn't be removed, right? But then if the firm itself actually does start to fail, then they can actually come and say, oh, never mind, we actually think he needs to go.
You know what? Yes, totally. And we even found clauses that said you have to keep so-and-so, but we'll allow you to replace so-and-so as long as your replacement meets our approval. So they required approval on the CEO's replacement. So it's pretty amazing. And so with Lionsgate, it wasn't the CEO, it was the head of the creative development department, which was really cool. We thought, right? And so what actually happened was, I think it was a he. I can't remember for sure, but I can't remember. I want to say it was a he. But he, the head of the creative development department, was at Lionsgate through the course of the loan. The loan expired. He left. A lot of people went with him. He started his own company, blew up, and then Lionsgate bought it back from him. And so it turns out he was actually critical to Lionsgate. The bank totally knew what they were doing. It's pretty awesome. So I'm going to blast through this last one because it's getting close. And I don't want to keep y'all like the full hour. But I do feel like having questions during was probably a little bit better than waiting to the end. The last one was executive compensation. And what we basically found was, oh dear, I don't want to explain I'm just going to give you the punchline without explaining the statistics, because you've been super patient with me and there's less than 10 minutes left. What we found, when companies violate some of the loan covenants and they get thrown into technical default, what they will do on average, it's not everybody, and it's in certain situations too. It's not all companies all the time, but firms that really, really need the loan or firms that are in a tough position, what they'll do is they'll redesign the executive's compensation packet the following year to make it more creditor friendly. They will switch the ratio of how much stock options versus how much pension, make the compensation more pension heavy, more debt-like. They will change the horizon of the options. They will do different things like that to try to better align the executive's compensation and incentives with what the debt holders want, so that the debt holders will be like, okay, cool, we'll let you keep going and we'll give you a little bit of grace. So this is something else that we're working on. That's really, that's statistical stuff. So with corporate governance, you got this word cloud I found, and creditors is in the word cloud, but it's like really small down here. And I think that like what research, not just mine, but certainly what I'm working on, what other people are working on as well recently, has shown that creditors should be here, but it should be a little bit bigger, right? There's more influence that creditors are having on corporate governance than we've traditionally thought. So I hope that this has been somewhat interesting for you and you learned something. Great to see those of you that I know. Appreciate y'all coming, and thanks for having me.
Thank you. Thank you very much.
Thank you.
Fantastic.
I think
Thank you.
we have time for one question,
Thank
if
you.
that's all right. And the question that we got during the event was, how many banks usually participate in the syndication of a loan, and is there a cap?
Great question. No cap, and there is large variance. So I want to say the mean for publicly traded U.S. companies is going to be around 5, but it depends on the size of the loan, the size of the company, right? So, but I've seen 2 to 15. Yeah. So what happens is, just take a minute. And so what happens is there will be a lead arranger. And so this will be one of the big banks typically. They're the one who's going to have a contact with the company. And so they'll do the due diligence. They'll come up with terms. They'll argue and haggle about the terms and the price and everything and all. And then they'll contact other banks and say, hey, do you want some of this? Or it's not only banks. It can be other like non-depository financial institutions like hedge funds, and even insurance companies are getting into this quite a bit too. So actually, I think half of the outstanding syndicated loans in the United States right now are held by non-depository financial institutions.
And Brian, is there also kind of like a minimum loan amount that's syndicated for each of the syndicators as well? I understand like there's the big bank that's like the lead bank, but if it's like $1 billion is like the minimum 100 or 500 million or something like that.
Yeah, it's going to vary a lot across syndicate, Nat. So sometimes you'll see a reasonably small investment. And yeah, actually, one thing that's kind of interesting, some of the research has looked at, is what determines how much the lead arranger holds.
Right.
And so one thing that and this is, again, they're very much accounting research, is like when the company that's the borrower, when the borrower is particularly opaque and there's not as much high quality information out there, the lead arranger tends to hold a larger portion of the loan to themselves to kind of signal to the other participants, hey, I'm taking the brunt of the risk here. So, but yeah, there's no technical minimum.
Thank you.
Awesome.
Yes,
Sorry. We are running really short on time. So what I'm actually going to do is we're going to like say our piece, and then I can make Dr. Akins the host. So if y'all want to stick around for a couple minutes and ask questions afterward, you can certainly do that. But we do want to make sure all of you have a chance to get ready, run and grab like a snack or whatever for our last lecture that's going to start at 2 o'clock. So I just want to say thank you so much, Dr. Akins. You know, of course, we know you're a well-loved professor, but you're also one of our alumni. And we're always so happy to engage our alumni in this way. So we're so grateful to you for doing this presentation and for being part of Alumni Reunion Week 2021. So thank you so much. I'm sure that all of our muted video people are clapping because I am.
We are.
And perfect. I'm glad to hear it. Once again, I just want to say thanks to all of you who were able to join us. It is a Saturday. I know there's a lot going on in your lives, so we're grateful you took time out to join us today. I want to really quick plug the swag shop. If you guys haven't already gone to the swag shop in the exhibitor hall, Shauna will put the link in the chat. It's going to close on April 30th, so make sure to get your orders in of this sweet Bull and Bear shirt, as well as a couple other things that we have. And then finally, I know Shauna and Chris mentioned giving in the beginning, but just a reminder, if you would consider making a gift in honor of your reunion before the end of the week, that would be great.